So here we are on my slide about the index tracking alternative to discretionary stock picking, to so-called active fund management. Most people will by now be aware what index trackers are. They simply track a stock market index or indeed a commodity price. There are trackers for oil, for gas, for the price of silver, for the price of gold, and so forth. They've really all grown since about 1996. But index trackers are active. Any talk of an index tracker being a passive way to invest is misleading nonsense. All you've really got to do to realize this is to go and read the methodology documents of the various equity indices to realize this. Index tracking is very simply rule-based quantitative investing. The vast majority of stocks, the vast majority of equities, they crash and they burn. They go bust. Index tracking is a way to avoid the worst of this. So rule-based stock indices are in fact algorithms. It's algorithmic investing. Over time, historically, indices and equity indices have tended to increase in value as growing companies come into the index and replace those companies which have gone ex-growth and drop out. So the blunt fact, which is really not terribly widely realized or talked about, is that stock indices and the ETFs which follow them are in fact trend following systems and very effective ones at that. And you've got some jokey pictures here. You've got the lunatic stock picker at the top with his phones and his fuss and his bother and his all the employees and the fuss around trying to outperform the market, which of course he never does. We go through an area of calm in the middle, and we get to the rather more cerebral index tracker at the bottom. It's a world of calm and reason, guided by maths and statistics, not gut feel. So avoid the guy at the top, in my view. So, you know, I've already said, as you can see here, that index trackers are active. It is not passive fund management, very far from it. Here's a picture of of my Reuters screen. You can track all world markets, all the major ones and many of the minor ones using index tracking ETFs. You can get massive diversification very simply and very cheaply. So we're on to the next topic here, diversification. Absolutely vital. All that index trackers do away with in risk terms is stock-specific risk. You can have hundreds of stocks in your portfolio using ETFs, but that really doesn't go far enough. If you had held, if there had been an index tracker on the Russian market in 1917, and you'd been a Russian and you'd had all your money in the Russian stock market, you'd have lost everything. Similarly, if there was a tracker for German government bonds in the 1920s, you would have lost all your money, and indeed the middle classes were largely wiped out in Germany in the Weimar Republic. So, look, it's true you can't diversify away everything, and you know no amount of diversification would have been much practical use. To the dinosaurs 65 million years ago, there are events which you can't foresee and you can't diversify away. But we just have to do the best we can. So obviously the moral here is don't put all your eggs in one basket. Practically speaking, what you need to do is to diversify very widely. You should select a group of asset classes, and frankly, you will then you'll have done your best. Stocks, shares, physical property, land, commodities. Spread your investments if you can across global markets and currencies. You know, you can mitigate a disaster like the Wall Street crash, or indeed the collapse of long-term capital management. Those rather jokey pictures, which I put on the screen, by diversifying into gold, commodities, and various other asset classes. Read Nassim Taleb's Black Swan. Very good book on how so much risk is non-predictable. Look, so in terms of practical diversification, here is an example portfolio of a reasonably diversified portfolio, all of which can be put together out of index tracking ETFs. So in that example, the diversified portfolio contains 22 different world stock indices and a few commodities. That really might be expected to provide reasonable diversification. And if we go on to the next slide, you'll see it's a chart of what historically a dollar-based investor would have reaped had he invested equal amounts in that 22 counter portfolio at the beginning of 1990 and simply held it over the years without any rebalancing. In risk terms, in terms of annualized standard deviation, that was 14% for the period. It looks not unreasonable, but do note the horrendous peak to valley drawdown of well over 50% in 2009. Now, that's no worse than the market. I think the S&P 500 was down 55% at that stage. Nonetheless, it's not comfortable to live through. And while it's no worse than the great majority of managed funds, I believe that there are ways to mitigate that drawdown. And that really is the main subject of this presentation, which we will come on